The biggest lie in global economics isn't hidden in some classified document. It's repeated on television every single night. The idea that America's trade deficit with China is proof of weakness. But what if I told you the trade deficit isn't a failure at all? What if it's actually a strategic pillar of American power? Think about that for a second. If trade deficits were fatal, how is the United States still the world's largest economy at $27.3 trillion in GDP? Why hasn't the dollar collapsed? Why do global investors still run toward U.S. Treasury bonds during every crisis? Here's what mainstream commentary gets wrong. They treat the trade deficit like a scoreboard. Imports bad, exports good, deficit equals losing. But global trade doesn't work like a football match. It's a capital flow system. In 2023, the U.S. goods trade deficit with China was approximately $279.4 billion. Politicians call that a loss. But this is the part that should surprise you. That deficit represents Americans buying cheaper goods, which lowers inflation, boosts consumer purchasing power, and allows U.S. capital to flow into higher margin industries like software, AI, and advanced manufacturing. Most people think a country should make everything at home. But here's what's really happening. America offloaded low-margin manufacturing to China and kept high-margin intellectual property. Apple designs in California. It manufactures in China, the margins stay in the US. Let me show you what this actually means. When you buy a $1,000 iPhone, only a fraction of that goes to Chinese assembly. Estimates show Chinese assembly captures roughly $25–30 per device. The rest, design, software, marketing, ecosystem services, flows back to American firms. The trade deficit counts the entire import value. But value creation? That's a different story. When I was in Beijing last year, I asked a supply chain consultant how he viewed the U.S.-China trade imbalance. He laughed and said, "You call it a deficit, we call it a service." That stuck with me, because underneath the political rhetoric is something more structural. So here's the framework I want you to think about. This isn't just about trade numbers. It's about three systems operating simultaneously. System 1, the consumer subsidy machine. System 2, the dollar recycling engine. System 3, the innovation flywheel. Stay with me, because what comes next changes how you see this entire debate. Let's start with System 1, the consumer subsidy machine. Here's what nobody tells you. Chinese imports function as a massive subsidy for the American middle class, not through taxes, through price compression. Between 2000 and 2018, economists at MIT and other institutions estimated that increased Chinese import competition reduced U.S. consumer prices significantly across categories like electronics, furniture, and apparel. Lower input costs ripple through the economy. Cheaper goods mean lower CPI pressure. Lower CPI pressure means the Federal Reserve can maintain looser monetary policy than it otherwise could. This is the trade deficit paradox. The mechanism that looks like weakness becomes a source of strength. If you want to understand inflation control over the past 2 decades, just look at Walmart shelves. Just look at Amazon's supplier base. Just look at how many goods originate from Shenzhen and Guangdong. That supply chain scale keeps American consumption humming. Here's what matters. The United States is a consumption-driven economy. Roughly 68% of U.S. GDP comes from consumer spending. If you disrupt cheap imports overnight, you don't just shrink a trade deficit, you spike prices. And we saw a preview of that during the tariff escalations between 2018 and 2020. Studies found American importers bore most of the tariff costs. That's not political commentary, that's data. Prices adjusted upward. So the uncomfortable truth is this. America's political class publicly criticizes the trade deficit while quietly relying on it to sustain domestic economic stability. But that's only the first layer. Because while cheap imports stabilize consumers, something even more important is happening behind the scenes. Dollars don't just disappear when Americans buy Chinese goods. They come back. And the way they come back is what makes the second system far more powerful and far more misunderstood. And once you see how that dollar recycling engine works, you'll realize the trade deficit isn't just tolerated by Washington. It's structurally embedded in how the United States finances its global dominance. So here's the second force at work, and this one operates completely differently. If System 1 is the consumer subsidy machine, System 2 is the dollar recycling engine. And this is where most Western analysts completely miss what's actually happening. Have you ever wondered what China does with the hundreds of billions of dollars it earns from exporting to the United States? Those dollars don't sit in a vault in Beijing. They come back. This is the part that should surprise you. When the U.S. runs a trade deficit, it must run a capital surplus. That's not opinion. That's accounting identity. If America imports more goods than it exports, foreigners accumulate dollars. And those dollars have to go somewhere. Let me show you the numbers that matter. As of late 2023, China held approximately $867 billion in U.S. Treasury securities. Not $900 billion, not around $1 trillion. $867 billion. That makes China one of the largest foreign holders of U.S. government debt. Here's what mainstream gets wrong. They frame this as leverage over America. But think about the incentive structure. If China suddenly dumped those treasuries, what happens? Bond prices fall, yields spike, and the value of China's remaining holdings drops instantly. It would be financially self-destructive. Most people think creditor equals power. But here's what's really happening. The U.S. gets goods. China gets paper assets denominated in dollars. And those dollar assets are only valuable if the U.S. system remains stable. When I spoke to a senior economist in Washington, off the record, he put it bluntly. The trade deficit finances itself. That's the paradox. America consumes. China exports. The dollars flow back into treasuries, real estate, equities, and corporate bonds. That capital inflow keeps U.S. interest rates lower than they otherwise would be. Here's what matters. The United States runs persistent fiscal deficits. In fiscal year 2023, the U.S. federal deficit was approximately $1.7 trillion. That gap must be financed. Who buys the debt? Domestic institutions and foreign holders recycling trade dollars. This connects to something even bigger, and I'll show you in a minute. Because this recycling mechanism reinforces the dollar's global reserve status. About 58% of global foreign exchange reserves are still held in U.S. dollars. Not euros, not yuan, dollars. That demand creates structural support for U.S. borrowing capacity. Now let's ground this in a real-world example. During the 2008 financial crisis, global investors didn't flee from U.S. assets. They ran toward them. Treasury yields collapsed as capital sought safety. The very system critics say is fragile became the safe haven. That's the dollar recycling engine in action. And here's the uncomfortable implication. If America eliminated its trade deficit with China tomorrow, the global dollar circulation system would tighten dramatically. Fewer exported dollars means fewer recycled purchases of U.S. assets. That means higher borrowing costs. Higher borrowing costs for whom? The U.S. government, American corporations, mortgage holders. Stay with me because what comes next changes everything. This is the trade deficit paradox again. The imbalance that looks like economic weakness underwrites America's financial dominance. But let's not romanticize this. There are risks. Dependence cuts both ways. Supply chain vulnerabilities are real. The semiconductor shortages during 2020 and 2021 exposed that fragility. Concentrated manufacturing creates geopolitical leverage. Here's what nobody tells you. The real risk isn't the trade deficit itself. It's the over-concentration of critical inputs. That's a supply chain architecture problem, not a simple deficit problem. If you want to understand this properly, just look at what the US is doing now. It's not trying to eliminate all Chinese imports. It's targeting specific sectors, advanced chips, critical minerals, defense-adjacent technologies. That's strategic decoupling, not economic divorce. Because policymakers understand something publicly unspoken, collapsing the dollar recycling engine would destabilize America's own financing structure. This is the part that should terrify simplistic narratives. The weapon that was supposed to create strength, aggressive tariff reduction of deficits, can become the weakness if executed bluntly. So we've covered System 1. Cheap imports stabilize the consumer economy. We've broken down System 2. Trade dollars cycle back to finance U.S. deficits and reinforce dollar dominance. But there's a third system, and in my view, it's the most underestimated. It's the Innovation Flywheel, and it explains why America didn't hollow out, despite outsourcing so much manufacturing. And once you see how that flywheel works, you'll understand why the trade deficit debate isn't just about goods. It's about who captures the future. So here's the third force, and in many ways, it's the most misunderstood of all. System 3. The Innovation Flywheel. Most people think when manufacturing moved to China, America hollowed itself out. Factories closed. Towns struggled. Therefore, the country must have weakened. That's the surface narrative. But here's what mainstream analysis gets wrong. They assume production volume equals value capture. Let me ask you something. Where are the world's most valuable companies headquartered? As of 2024, the United States accounts for 8 of the top 10 largest firms by market capitalization. Apple, Microsoft, Alphabet, Nvidia, Amazon, Meta. The list is not random. This is the part that should surprise you. America didn't just shift factories overseas. It shifted its economic center of gravity upward into design, software, semiconductors, aerospace, biotech, and finance. Here's what matters. High-margin innovation scales differently than low-margin assembly. Take Nvidia. In fiscal year 2024, Nvidia reported revenue of $60.9 billion, with gross margins exceeding 70% in certain quarters. That's not 7%, 70%. The chips may be fabricated in Taiwan and assembled across Asia, but the intellectual property, the architecture, the software ecosystem is American. This is the innovation flywheel at work. Outsource commoditized manufacturing. Reinvest capital into R&D, capture global premium margins. When I talked to factory workers in Shenzhen years ago, they didn't describe themselves as building global brands. They described themselves as fulfilling contracts. That distinction matters. Contract manufacturing generates employment. Brand ownership generates outsized profit capture. If you want to understand who wins in global capitalism, just look at operating margins. Apple's net income in fiscal 2023 was approximately $97 billion. Not revenue, net income. And a large share of its products are assembled in China. The trade deficit records the import value, but the profit ledger tells a different story. Now here's the uncomfortable truth. America did lose certain kinds of jobs. The so-called China shock between 1999 and 2011 contributed to significant manufacturing employment declines in specific regions. Studies estimate up to 2.4 million U.S. jobs were affected by rising Chinese import competition. That's real. Communities felt that. But here's what makes people uncomfortable. The broader economy reallocated capital into sectors with far higher productivity growth. U.S. labor productivity has increased roughly 62% since 1990, not evenly distributed, not politically painless, but structurally transformative. This is the paradox statement. The outsourcing that looked like decline became the funding source for technological acceleration. Because here's what nobody tells you. Cheaper imports don't just help consumers. They lower input costs for American businesses. Lower costs free up capital. That capital flows into venture funding, into AI research, into biotech labs. Let me show you what this actually means. In 2023, U.S. venture capital investment totaled approximately $170 billion even in a down year. That innovation ecosystem doesn't operate in isolation. It's supported by deep capital markets, which are reinforced by the dollar recycling engine we just discussed. See how these systems connect? System 1 stabilizes consumers. System 2 finances deficits and keeps capital abundant. System 3 converts abundant capital into high-margin innovation. Stay with me because what comes next changes how you see geopolitical competition. Most people frame US-China trade as a zero-sum contest over factories. But here's what's really happening. It's a layered competition over who controls standards, software platforms, semiconductor design, financial rails, and AI infrastructure. And this is where the trade deficit debate becomes strategically misleading, because if you fixate only on goods imbalance, you miss the services surplus. In 2023, the United States ran a services trade surplus of over $278 billion globally. Financial services, intellectual property licensing, cloud computing, these flows don't show up in the same political speeches. This connects to something even bigger. The real competition isn't about eliminating trade. It's about upgrading the hierarchy of value capture. And here's the part that should terrify simplistic narratives. If America aggressively dismantled trade flows without rebuilding domestic cost structures first, it could choke its own innovation flywheel. Higher input costs, higher consumer prices, higher interest rates, lower venture funding, slower innovation. That's the cascade risk. But there's still a catch, because the system only works as long as geopolitical tension doesn't fracture it beyond repair. And that's where we need to pull everything together, because the future of this so-called trade deficit lie isn't binary. It branches into three very different scenarios. Let me explain. So, let me pull this together. We've walked through three systems that almost nobody explains in one coherent framework. System 1, the consumer subsidy machine. System 2, the dollar recycling engine. System 3, the innovation flywheel. Individually, each system makes sense. Together, they form something much bigger. I call it the strategic imbalance architecture. And here's what mainstream debate gets wrong. They treat the trade deficit like a policy mistake to be corrected. But what if it's not a bug? What if it's a structural feature of how the United States projects economic power? Think about the paradox we've uncovered. America imports hundreds of billions in goods from China. In 2023, the bilateral goods deficit was roughly $279.4 billion. Critics call that dependency, but the same mechanism lowers consumer prices, finances government borrowing, strengthens the dollar's reserve status, and fuels high-margin innovation. So the weapon that was supposed to signal weakness becomes a pillar of strength. But here's what matters. Strength doesn't mean invulnerability, because the entire strategic imbalance architecture rests on stability. It assumes trade flows continue. It assumes capital recycling persists. It assumes geopolitical rivalry stays below open economic rupture. And that's where the future splits. Let me lay out three scenarios. Scenario 1, managed competition. In this path, the US and China continue selective decoupling in sensitive sectors, semiconductors, advanced AI chips, defense technologies, while maintaining large-scale trade in consumer goods and industrial inputs. Tariffs remain targeted. Supply chains diversify gradually toward Vietnam, Mexico, India. In this world, the trade deficit narrows slightly but never disappears. The dollar recycling engine keeps operating. Innovation continues. Tension remains high, but interdependence prevents collapse. If you want to understand why policymakers lean this direction, just look at bond markets. U.S. Treasury yields react sharply to instability. Nobody in Washington wants to test how far that system can stretch. Scenario 2, aggressive decoupling. This is the path many political voices advocate publicly. Rapid reshoring, broad tariffs, financial restrictions. In theory, it reduces dependency. But here's the uncomfortable truth. Rapid decoupling would almost certainly mean higher consumer prices in the short term. Studies during earlier tariff rounds showed U.S. importers bore most of the costs. Multiply that across supply chains, and you're looking at inflationary pressure. Higher inflation means higher interest rates. Higher interest rates mean higher federal borrowing costs. In fiscal 2023, net interest payments on U.S. debt already exceeded $659 billion. Not projected, actual. Now imagine that number rising sharply. This is the part that should make people pause. Economic nationalism sounds powerful, but executed bluntly, it can undermine the very financial dominance it seeks to protect. Scenario 3, structural rebalancing. This is the most complex path. The U.S. keeps strategic trade flows with China, but simultaneously rebuilds domestic capacity in key sectors: semiconductors, energy infrastructure, advanced manufacturing, through targeted industrial policy. We're already seeing early moves, incentives for chip fabrication, investments in clean energy, diversification of rare earth supply chains. Here's what nobody tells you. True resilience doesn't require eliminating the trade deficit. It requires reducing concentration risk while preserving the innovation flywheel. When I spoke with a former Treasury official, he put it this way: you don't dismantle the engine while you're still flying the plane. That line stuck with me, because this entire debate isn't about loving or hating trade deficits. It's about understanding systems. Most people think strength is self-sufficiency. But in a $105 trillion global economy, power often comes from shaping networks, not isolating from them. If you're finding this valuable, hit that like button, because these conversations need more nuance than cable news allows. Here's the final uncomfortable truth. America doesn't need Chinese imports in the emotional sense. It needs what they represent in structural terms: cost efficiency, capital recycling, and competitive pressure that forces innovation. Eliminate those without replacing them intelligently, and you risk weakening the architecture that underpins dollar dominance. This is the trade deficit paradox. The imbalance that looks like decline can, under certain conditions, reinforce power, but only if managed strategically. So now I want to hear from you. Do you think the U.S. can preserve its innovation flywheel while reducing dependency? Or does any serious decoupling inevitably break the system? Subscribe if you want deep dives that challenge surface-level narratives. And in the comments, tell me which scenario you think is most likely: managed competition, aggressive decoupling, or structural rebalancing. Because the future of global power won't be decided by slogans. It will be decided by systems.